Hi folks, welcome to the second part of the question 2 video. You might recall that this video focuses on business combinations comparing a purchase of net assets to a purchase of the outstanding voting shares of the subsidiary company. So let's just remind you of where we left off in video 1. In video 1 we were looking at two companies, Abdul and Lana, their balance sheet amounts at the end of June year 2. And then here we are, the next day, July 1st, year 2, Abdul purchased all of Lana's assets and assumed all of Lana's liabilities for $58,000 in cash. We saw in the question that the fair values were different than some of the carrying values for some of the assets and the long-term debt. So what we did in the part 1 video is we recorded the journal entries for a purchase of net assets. We recorded the entries that Abdul would make and that Lana would make. And we also did the separate entity balance sheets for Abdul and Lana after the business combination took place through a purchase of net assets. Now, you remember with the purchase of net assets, one of the key things we said is that Lana is now going to wind up. Why? Because they have nothing more than the $58,000 in cash that Abdul gave them to operate their business. So we went through that in part 1. Now we're going to come back to the same data that we had, but we're going to focus on part C in our second video, and assume that Abdul did not purchase the assets and liabilities of Lana, but instead they went to Lana's shareholders and bought all of the outstanding common or voting shares directly from Lana's common shareholders for $58,000 in cash. So now what we want you to do is to make the entry in Abdul's books, prepare an acquisition differential calculation, and to calculate goodwill at July 1st, the date they became related. So again, because it's a purchase not of net assets, but a purchase of the outstanding common or voting shares directly from Lana's shareholders, we assume now that Lana will continue to operate. Why? If we wanted to take Lana right out of the play, Abdul would have just bought up their net assets, so they have nothing more to operate with. But they didn't. They want Lana to continue. So all they did was buy their outstanding voting shares to effect the business combination. So they went directly to their shareholders. So with that in mind, we have to do the acquisition differential calculation and find goodwill. We're also going to make the worksheet entry on the consolidated in the consolidated books to facilitate the preparation of the consolidated balance sheet. That's the only statement we'll look at July 1st, year 2, and we will do that consolidated balance sheet at the date they became related. So now let's begin by looking at the solution. So in this case, Lana is not going to make an entry here at the date they become, or Abdul is not going to make an entry at the date they become related to Lana to record all of the assets and liabilities on its separate entity books. No, it's just going to debit the investment in Lana and credit cash for $58,000. And this investment in Lana will be in its separate entity books, right? Now, to calculate the acquisition differential and goodwill at July the 1st, we do it the way we're normally used to doing it, the way we learned we do it when we have consolidated calculations to do. Our schedule looks at what we paid to get 100% control and what we got in return for it. Don't forget, Lana had common shares of $40,050. They had a retained earnings deficit, not a credit or positive balance, but a deficit. So they're taking more out of the business than the business is making in equity, right? So that meant that they're deficient by $13,100. So the book value of net assets is $26,950, but we paid $58,000 as Abdul. So the acquisition differential is $31,050. That's the excess of cash paid over the book value of net assets. So why in the world did Abdul pay $31,050 more than the book value of net assets that they control? Well, don't forget, they saw fair value increments in the inventory of $1,900 because Lana had the inventory booked at $8,150, but Abdul thinks it's worth $10,050. That's a $1,900 increment. Property, plant, and equipment. Well, Lana's got it booked at $66,350, but Abdul thinks it's worth $70,100, which represents a $3,750 increment. And the long-term debt. Lana's got it booked at $40,100, but Abdul thinks the debt's worth less. So that's a good thing for Abdul because they say this debt is not as high as you have it booked at. So there's an increment there, $6,300. I call it an increment because even though it's gone down, it's to the good. It's to the benefit of Abdul because they're paying but getting less debt that they control, right, from Lana. So now we've got $11,950 in fair value increment in comparison to what the acquisition differential is. That means we've wound up accounting for $19,100 of that acquisition differential being goodwill. So to make the worksheet entry to facilitate the preparation of the consolidated statements, and don't forget at the date of acquisition, the only thing that Abdul's going to do is a consolidated balance sheet, right? But in order to prepare that consolidated balance sheet, we need to start up with some numbers on it, right? So we do a worksheet entry, not on Abdul's books, not on Lana's books, but on the consolidated books. So Abdul's accountants would do this because they're the parent company, right? So they'd eliminate the common shares of Lana, and they'd also eliminate the deficit for retained earnings that Lana booked. Lana had a deficit of $13,100, and they had common shares of $40,500. So don't forget, when we're preparing the consolidated balance sheet, which is what we'll prepare at July the 1st, right? We're doing it for the benefit of Abdul's shareholders, not Lana's shareholders. So Abdul's shareholders do not want to see the common shares of Lana or the retained earnings deficit of Lana. Don't forget the retained earnings deficit is a normal debit balance, right? It is a debit balance, right? So we're going to credit it to zero it out. And again, we're not zeroing it out literally, just to prepare the consolidated statements, right? So we're making this worksheet entry, as we said, on that third set of books, not on Abdul's books and certainly not on Lana's books. So we're going to credit the retained earnings of Lana to remove the deficit from the consolidated books, and we're going to debit the common shares of Lana to remove that common share balance from the consolidated books. We're going to set up our increments for inventory, for P&E, as well as our decrement or our reduction in the long-term debt. We saw that here, up here when we did the calculation of goodwill. And don't forget, we also have to set up the goodwill here. So that's $19,100 that gets set up. So now, once we've got that worksheet entry set up on the consolidated worksheet, now we're in a position to do the consolidated balance sheet at July 1st, year 2. So, 3-line title is going to show the name of the company, Abdul, the fact that it's a consolidated balance sheet, and at a date, which is the date they became related, which is July the 1st, year 2. So now, don't forget, we would not be doing a consolidated balance sheet at June the 30th. Why? Because although we have the data and we're going to use it, right? Some of the June 30th data, the fact of the matter is they didn't become related until July the 1st, and that's the date at which we can start preparing consolidated statements. So now if we go back to the solution, we're going to start with the cash and receivables in the asset side. You'll recall in the question that Abdul's was $93,000, Lana's was $20,150, but this $93,000 was at June the 30th. We're doing our consolidated balance sheet at July the 1st, and don't forget, we reduced our cash when we recorded the investment by $58,000. That was what Abdul did. So don't forget, this entry here, so you see I got the red guys here, right? Investment in Lana debited and credited cash. Don't forget that was on July 1st, year 2. Well, again, on the consolidated statements, I have to factor that in because that was at June 30th, that balance. So I'm going to have $55,150 in cash and receivables. Don't forget, I picked up my carrying value as Abdul of my inventory, Abdul's inventory. the carrying value of Lana's plus the fair value increment. So together, here's my $10,050 in fair value. Don't forget, when I'm doing the consolidated statements under the acquisition method, what am I doing? I'm picking up as Abdul my carrying value plus the fair value of Lana's, which is the carrying value plus the fair value increment. So I add those three little guys together, I get $70,550. And don't forget, the blue number here, the increment, you can see all the increments I set up here. I set up the increment for inventory, P&E, and I also set up the decrement for the long-term debt. I'm carrying those amounts over into my consolidated balance sheet at July 1st, year one. Because to prepare the consolidated balance sheet, I'm going back to my worksheet entry and picking it up. I'm just showing you how I pick up all those little blue guys here, okay, how I pick them all up on the consolidated balance sheet at the date we became related when we are using the direct method, right? So here I'm picking up my carrying value for the P&E. I'm picking up the carrying value of Lana plus the fair value increment. So together that gives me the $70,100, okay, $70,100 of my fair value. And again, that's where we picked it up here, right? We picked up the carrying value here, 66,350 plus the 3750, right, for our P&E, right? That's going to give you again the 70,100, right? So now I've got 306,100 on the consolidated statement. Notice here, I tell you in the double asterisks that there's no balance in the investment account in Lana. Why is that? Because don't forget, when Abdul bought the investment, they debited the investment account on July 1st, but don't forget, you also posted to the consolidated worksheet this entry that eliminated the investment account. So $58,000 went in at the date you recorded the investment on your separate entity books. But again, for consolidation purposes, the third set of books, because that investment account is broken up into all its component pieces, which would be the carrying value, all the fair value increments, right, and the goodwill, that's all broken up. You're picking up the goodwill. You're picking up all the increments and decrements, right? You're eliminating the carrying value. You're eliminating the common shares and the retained earnings deficit that Lana had. That's all broken up in the investment account. So we eliminated it when we did this guy, right? So that's factored in here, so the investment account is zero, and I explain all of that to you down here. So now we've got the goodwill set up, so you can see our total assets are $450,900. Let's compare that to our consolidated balances for the liability and shareholders' equity accounts. So again, we had no increment or decrement on the current liabilities. So again, the carrying value of Lana's current liabilities is the same as its fair value. So our carrying value, Lana's fair value, 93.1 for the current liabilities. Notice we're only picking up at net the fair value. We're picking up the carrying value plus the decrement. So plus a minus is minus 6,300 added to Abdul's carrying value gives us $128,050. And don't forget, we're picking up Abdul's common shares. We've got the common shares of Lana, but don't forget we're eliminating them. So it's an in and an out. So at net, we're not picking up any common shares of Lana. Why? Because don't forget, we eliminated them here, right? We eliminated them. So when we eliminate those common shares of Lana, not on Lana's books, we didn't do it. We did it on the consolidated books because don't forget, it's all kind of subsumed as part of that investment that we're eliminating, right? So we eliminate it because, again, the shareholders of Abdul only want to see the common shares of Abdul, right? That's what they want to see. They don't want to see the common shares of Lana. Why? Because they're not shareholders in Lana. They're shareholders in Abdul. So we eliminate them. So I just show the in and the out so you can see how it's totally brought to zero. So we only pick up the common shares of Abdul. And we're only picking up the retained earnings of Abdul. Why? because that deficit got eliminated on the worksheet right here. So we're only picking up the retained earnings of Abdul. So you can see here the total liabilities and shareholders' equity add up to $450,900, which is the same as the total assets. So this concludes our preparation of the consolidated balance sheet. Notice we did not do a consolidated income statement. Why? Because there's been no income earned while the two parties have been related. We're just doing a consolidated financial statement at the date they became related, so the only statement we can do here is the consolidated balance sheet. We'll learn more in a subsequent chapter how we can do consolidated income statements when the parent and the subsidiary have been related beyond the date of acquisition. Right now we're only at the date of acquisition. So hopefully this video has helped you a little bit to understand the purchase of shares of the common shares of the subsidiary company and how this impacts your consolidated process, as well as the preparation of the consolidated balance sheet.